Ever wondered if the real secrets to long-lasting business success aren't in the latest buzzwords, but maybe hidden away in like an old company document? Today, we're actually taking a trip back to 1988. Now, I know that might sound like ancient history in today's business world, but trust me, it holds some genuinely surprising lessons about building a company that's, well, truly resilient, one that can kind of defy market gravity. Our mission today is to dig into one specific, really powerful source, the Markel Group's 1988 shareholder letter. And this isn't just some dry financial report. It's more like a window into the core thinking of a company that's really known for its enduring success. We'll figure out not just what Markel did back then, but how they managed to defy the odds, achieve record results when others were struggling. We'll look at the principles guiding them, and maybe most surprisingly, why this, let's call it ancient playbook, actually offers some incredible relevant lessons for the challenges you might be facing today.
That's a great way to put it. Shareholder letters, especially from companies like Markel, companies known for thinking long-term, they're often these overlooked gold mines of insight. They really go beyond just the numbers. They give you this rare glimpse into, well, the company's strategic mind, its soul almost,
Yep.
and the core values that actually drive decisions. This 88 letter, it's a fantastic example. It lays out a philosophy that turned out to be remarkably forward-thinking and, frankly, still resonates today. Navigating the soft insurance market of 1988, a paradox of success.
Okay, so let's dive right in. Let's unpack this. The letter kicks off highlighting record results for 1988, and we're talking total operating revenues up a massive 78% to $69.5 million. Net income soared 79% to $11.1 million. And net income per share jumped, 54% to $2.80? I mean, that's a huge leap, right? Practically doubling in a year.
It is huge. And what's really fascinating as you dig in is that these incredible results, they weren't happening in some booming, easy market. Not at all. The letter explicitly says they were achieved in a very competitive soft insurance cycle. Now, for anyone not familiar, a soft insurance cycle is, well, it's tough. It means intense competition, pressure driving premiums down, underwriting standards often get looser, it generally squeezes profits across the board, it can become a bit of a race to the bottom on price.
Right.
So pulling off those kinds of numbers in that specific environment, it immediately makes you ask, okay, how? How did Markel manage to buck the trend when so many others were probably struggling?
That really is the paradox, isn't it? Everyone else feeling the squeeze, and Markel is, well, thriving. And the letter points right to their strategy. It wasn't just about growing bigger or, slashing prices. They specifically mention diversifying into different segments of the insurance industry. Things like brokerage, claims, and underwriting, and specializing in unique product niches. So, yeah, not trying to be everything to everyone. Finding their spots and really digging in.
Exactly. And that's such a crucial insight, especially that counter-cyclical thinking. While lots of competitors were likely cutting prices, maybe spreading themselves thin just to keep market share up in that soft market, Markel was doing, well, the opposite. They doubled down on specialist areas. The letter mentions, for instance, big revenue jumps in really specific niches like transportation and even animal mortality insurance. And these were driven by acquiring specialists in those fields. The core idea here is that a soft market isn't soft everywhere. There are always pockets, underserved areas, less competition if you have the discipline to specialize. It's about knowing your unique edge and having the conviction to invest there precisely when others are maybe distracted by the broader downturn.
So it's not just having the niche, but having the foresight, the conviction maybe to invest more in it when things get tough elsewhere. Why do you think most companies miss that? Why don't they follow that playbook in a downturn?
Well, often it's fear, isn't it? The pressure, maybe short-term pressure, to just maintain market share or please analysts for the quarter. They can push companies to compromise. Compromise on pricing, on underwriting standards, just to keep that premium volume looking okay.
Right. Keep the top line healthy.
Yeah. But Markel, they understood that real profitability, especially in a soft market, comes from deep expertise and, crucially, being willing to say no. No to business that just isn't profitable. Their focus on these unique product lines, these targeted acquisitions, it let them carve out these highly profitable spaces. It minimized the hit from the general soft market. They were deliberately building strength where others saw maybe only weakness. Choosing quality, over just sheer quantity, it really speaks to patience and strategic focus. 2, the Markel way, underwriting discipline and strategic expansion.
Okay, that leads us right into their core insurance operations then. We see how they diversified and targeted niches in a tough market. But a huge piece of that success has to be how they manage the actual, the core business itself. What did the 88 letter tell us about the discipline there?
Well, the letter proudly points to a combined loss and expense ratio of 94% for 1988.
94%.
Yeah, and that's an absolutely crucial number in insurance. It basically tells you if they're making money on the policies themselves before you even think about investment income. Anything under 100% means underwriting profit. So hitting 94%, especially in a soft market, that shows incredible discipline. Discipline in pricing risk and in carefully managing expenses.
Mm.
Think about it. They're essentially paying out 94 cents in claims and expenses for every dollar of premium they bring in. That leaves 6 cents as pure underwriting profit. And they even note, interestingly, that without their conservative approach, the ratio might have been 95%. Still good, but their discipline pushed it even lower.
Exactly. So they were absolutely committed to earning underwriting profits, making money from the core business of, well, assessing and insuring risk. And that's so critical because, like you said, many insurers, especially when things get soft, they just chase revenue. They rate premiums, even if the business isn't really profitable, hoping they can make it up on the investment side. Markel's discipline meant they prioritized sound risk management, sustainable profit. That's a harder path, maybe, but much more resilient, right? Like building on rock instead of sand.
Precisely. It shows this deep understanding that in insurance, success isn't just how much premium you write. It's about how profitably you write it. So many get caught in that trap, growing volume just for market share, even if the policies are basically loss leaders. Markel was actively resisting that, focusing on the quality of their book.
It's fascinating, too, because it wasn't just defense, was it? Not just the underwriting discipline. The letter also talks about significant expansion acquisitions during this challenging time. So what did their offense look like in 80?
Yeah, that their offense was just as disciplined as their defense, really. They integrated companies like Lindsay and Newsome, which they bought in late 87, and Gordon Boyd, which came in right at the start of 88. These moves helped them expand into more states, bring in new accounts. I mean, they went from operating in 30 states to having 30 offices, adding, get this, 300 people in just 90 days.
Wow.
But again, it wasn't just random growth. It was targeted expansion into areas that fit their specialist strategy.
And these weren't just small bolt-ons either, right? The letter specifically calls out the acquisition of the Shand Evanston Group as, quote, the most significant reason for our increased net income that year. What was so special about that one?
That's a great question. Because even though Shand Evanston itself was apparently seeing declining premiums because of the soft market, Markel's plan wasn't just about boosting volume overnight. Their focus was integrating it effectively, managing it with their disciplined underwriting approach, aiming for underwriting profits there too, not just top-line growth.
Applying the Markel way.
Exactly. They saw a chance to bring their philosophy to what they clearly viewed as a valuable asset. And the letter's pretty candid, pointing out that despite the soft market, companies like Markel, and they mentioned Fairfax and Morton and Helwig too, these were the ones that seemed to, quote, prosper regardless of the cycle. It even talks about Fairfax Financial buying Evanston, and Markel then getting equity in Fairfax's earnings from that deal. They projected a healthy return, like 17 to 23% for 89.
That really gets to the heart of it. This approach, it's rooted in what they call the Markel way. The letter spells it out. Seeking to be a market leader in each pursuit, deeply understanding customer needs, providing quality products and service. It's about creating deep value, not just chasing volume. So in an industry that can sometimes feel like a commodity, they were really striving to be, well, exceptional.
And that's such a timeless lesson, isn't it? It means going beyond just the transaction. The Markel way, as described here, it's a philosophy. They don't just sell policies. They aim to be the best in their chosen niches. Really understanding their customers, their agents, the specific risks they cover, this focus on customer and quality over just grabbing market share, that's what lets them thrive when others struggle. It builds loyalty, provides a buffer against price wars, because people value expertise and reliability, especially for something as vital as insurance. 3. A glimpse into capital allocation, investing with intent.
Okay, so we've got disciplined underwriting, strategic niche focus, even in a tough market. What about beyond the core insurance? How was Markel thinking about its investments, its capital, back in 1988? Were they just as deliberate there?
Oh, absolutely. The letter shows a very clear, very thoughtful, and really intentional approach to deploying capital. This wasn't about making speculative bets on the side. For instance, it mentions that in June 1988, they acquired 250,000 shares of their own stock at $16.25 a share. And the proceeds from that offering, about $9.6 million, weren't just put into general funds. They were specifically earmarked to increase their investment in that key acquisition, the Shand Evanston Group.
Right.
So it wasn't random investing. It was directly supporting their core strategy, strengthening that key part of their business.
So they were actively raising capital using a stock offering, specifically to invest deeper into an asset they clearly saw as vital for their long-term plan. And the letter notes their goal was to, quote, retain additional shares for a relatively low price-earnings multiple. Essentially, buying at a price they felt represented good value, good future growth potential, and importantly, doing it in a way that avoided diluting existing shareholders too much.
Right.
That feels like a classic long-term value-oriented move.
Absolutely. It just speaks volumes about that long-term perspective, that focus on shareholder value that seems baked into their culture. They were strengthening their balance sheet, yes, with additional capital, but the decisions on where that capital went were clearly aligned with the overall company strategy, designed to build value over time, not just juice short-term returns.
Yeah.
They were building for the future, making sure their capital worked hard to support the core business and those strategic acquisitions, rather than just, sitting idle or chasing quick, unrelated wins. It's all part of an integrated strategy.
It also says something about their confidence in their own valuation at the time, doesn't it? To issue stock, but also prioritize minimizing dilution. It implies a belief that the capital raised would generate returns high enough to more than justify the new shares. They were very clear about the purpose of that money.
Precisely. It signals a really disciplined approach to capital management. They saw their stock as valuable currency, not something to be issued lightly. They were transparent. Here's how we'll use this capital to fuel strategic growth and build long-term value. That builds enormous trust with investors. It aligns everyone, management, shareholders, around that long-term goal. 4, leadership, culture, and the shareholder-first mindset.
When you read the letter, thinking about the leadership's voice, what kind of tone comes across? Is it overly optimistic, cautious? What sets it apart?
The tone is quite striking, actually, for a document like this. It's this really interesting blend. There's confident optimism, definitely, but it's mixed with this clear-eyed realism. They explicitly say they look toward the future with optimism, but then they immediately follow up by acknowledging the market is likely to remain soft in 1989 and probably beyond.
No sugarcoating.
Exactly. And that balance, that transparency about challenges, alongside confidence in their plan, that's just crucial for building trust. It tells shareholders, look, we're not making wild promises, but we understand the environment, and we have a solid strategy. It's a rare quality in leadership, frankly, even today. The temptation is often either just boundless hype or, excessive caution. They found that middle ground.
That transparency, especially admitting challenges ahead, it really does set a different tone, doesn't it? It feels less like a sales pitch and more like they're inviting shareholders to be, well, partners on a long journey. And what stands out to you about their core values, they state them so explicitly in the letter. They say, we support our customers, agents, suppliers, shareholders, and most importantly, our people. It is our people who make the difference and deserve the credit. That's pretty powerful for a financial doc.
That focus on our people, it's incredibly important. And you're right, it's often just glossed over in purely financial reports. But it speaks volumes about the culture they were intentionally building, one where employees aren't just cogs, but are recognized as the absolute drivers of success, saying, it is our people who make the difference. That isn't just, corporate fluff. It implies investing in them, empowering them, creating an environment where they can actually do their best work. And that, in turn, translates directly into better service, smarter underwriting, and ultimately those strong results we talked about. It's a whole ecosystem.
And it wasn't just talk, was it? They backed it up with actions showing financial health. The letter mentions renegotiating loans, reducing borrowing by $15 million, and significantly boosting shareholders' equity up 31% to $30.8 million, or 11.44 cents per share. That shows real financial stewardship behind the words.
Indeed. It shows they weren't just chasing growth at any cost. They were actively strengthening the balance sheet, reducing financial risk, cutting borrowing, boosting equity. Those are concrete steps that build resilience. And that's essential for long-term survival and success, especially in a cyclical business like insurance. It gives them the foundation to weather storms and jump on opportunities.
So yeah, it seems crystal clear they were consciously aligning what management did with what was best for shareholders in the long run, really embedding that shareholder-first mindset deep into the company.
Absolutely. The whole letter just breathes this commitment to sustaining this performance over the long term. They even explicitly encourage patience for compounding returns. It's just a testament to a strategic view, that values stability, disciplined growth, and sticking to core principles over, chasing fleeting trends or easy wins. They were setting expectations for a marathon, not a sprint, and that patient long-term approach, that's what allows them to make decisions that might seem unconventional in the short term, like specializing heavily during a soft market. They weren't just optimizing for the next quarter, they were building for decades. Outro
So we've taken this deep dive into Markel Group's 1988 shareholder letter. And wow, it's really clear this was way more than just a yearly recap. It was practically a foundational document laying out this powerful and, as it turns out, incredibly enduring business philosophy. We saw how they pulled off record results in that tough, soft insurance market through smart specialization and just incredibly disciplined underwriting. We looked at how they strategically deployed capital, not just spending, but investing with real intent in their core strengths. And we saw how their leadership emphasized their people, transparency, and this unwavering long-term shareholder-focused approach to creating value.
And these points, they aren't just interesting historical facts. These principles, underwriting discipline, niche specialization, careful capital allocation, a transparent leadership style, a people-first culture, they're truly timeless. They offer really powerful, actionable lessons for almost any business. Doesn't matter the industry or what the market's doing this year. They show that often it's the fundamental, strategic patience, sticking to your core values, that really wins out over chasing short-term fads.
Yeah. And for you listening, I think these insights really demonstrate that true long lasting success often comes from sticking to those core principles, holding firm to your values, even when the market seems to be screaming at you to do something else, something maybe easier in the moment. It's about understanding the environment, yes, but not being completely dictated by its short term ups and downs. It's about playing the long game, even when everyone else seems to be sprinting. So here's a final thought for you to maybe chew on today. Thinking about Markel's 1988 approach, maybe it's their counter-cyclical strategy, doubling down on niches when others retreat. Or maybe it's that unwavering focus on culture and long-term value when so many are obsessed with quarterly numbers. Which aspect do you think is most missing in businesses today? And perhaps more importantly, why do you think that might be the case? Just think about how applying even one of those principles might change things.